Thanks everyone for joining. I am Laura Webb. I'm a lawyer at Osler, Hoskin and Harcourt. I practice in our emerging and high growth technologies practice group, which is a group focused exclusively on the technology sector. I work with companies across the country as well as in the US and internationally on various matters relating to corporate finance, M&A, corporate governance, those kinds of things. So very, very much involved in the Vancouver, Victoria, Okanagan, sort of general BC space on investors putting money in and companies taking money. So that's a little bit about sort of Osler. Maybe what I can do is I'll have Jay from Rhino Ventures, who has joined me on this, to give you guys a bit of a background on Rhino Ventures and his role there.
Thanks, Laura. So I'll try and be really quick because we have a lot of stuff I think we want to try and get through today. So the very quick commercial on Rhino Ventures is that we started in 2015. Fraser and Dan, my co-founders in the fund, built a business called Recon Instruments. They raised a bunch of venture capital, ended up exiting that company to Intel. Intel Ventures was an investor in the company as well. And when they looked back in the rearview mirror and said, hey, what sucked the most about building a venture scale business in Vancouver, and this applies, I think, to Western Canada more broadly, it was by far and large the quality and the quantity of early stage capital that's available to entrepreneurs. So we set out in 2015 with that mission of solving that problem, raised what we called our minimum viable fund, which was $15 million. And then we raised a subsequent fund in 2018, which is 33. And we'll hopefully have some fun stuff to announce in 2021 about the future of Rhino and where it's going next. So our mission is really simple. We lead rounds for what we believe are the best and brightest entrepreneurs building massively scalable companies in Western Canada. We've done the lion's share of our deals in British Columbia. We just did our first deal outside of BC, an Edmonton-based companies, a software company. And recently, as recent as today, which is why I'm wearing my Christmas colors, because Christmas came early for us, we announced that we invested $22 million in one of our first investments, and that's in Thinkific. So you might be wondering, how the heck does a $15 million fund write a $22 million check? And maybe I'll leave that question for something that we can tackle as clickbait later on in the session here.
Awesome. Thanks for that. All right. So I think let's just dive in here. I'll try and keep an eye on the chat feature here in case there are questions that come up. But maybe just to kick us off, Jay, can you sort of give us your perspective on what's changed in terms of investing from a fund focus since COVID?
For specifically to Rhino, or the general kind of ecosystem?
Yeah, maybe just generally the ecosystem, and if you want to talk specifically about Rhino, feel free to.
So I on a broader kind of macro level, I think there's a tale of two very different outcomes and stories right now in the startup ecosystem. There is what I would say is the overabundance of growth capital that is breaking down doors, trying to force feed cash to companies because there's just a glut of cash that is sloshing around at that stage in the ecosystem. And it's not local funds. These are international funds that will do all kinds of crazy things to try to get access to businesses that are more than, say, $5 million. But realistically, the real momentum in the growth equity game starts around $10 million of recurring revenue. But so that market is arguably, in the 5 years I've been doing this, the frothiest I've ever seen it. The prices being paid are insane. The terms being offered, the amount of secondary versus primary, it's phenomenal to see and to witness and to be part of some of our growth stage companies that are getting some of these term sheets and interest from growth stage investors. And that part of the market, the most active and overpriced that I have ever seen in doing this for the last 5 years. And then go down the spectrum to the sectors that are disproportionately hit hard in this category. So think about the restaurant tech sector, for example, an industry or travel tech, a segment that might be out of flavor at the moment. And if you've yet to achieve that initial scale or have investors on the cap table that are willing to look around the next corner and make that bet for what 2021 and 2022 is going to look like, it's a really difficult environment for those businesses out there. I would also rope in super early stage businesses. It's been very difficult for the most part. From what I've seen, the overabundance of cash in the venture ecosystem is tailored towards that Series B kind of plus segment. It's still very tight at the pre-seed and seed stage. And so when we're looking at deals, frequently it's us plus super angels that are participating and leading these early stage deals.
And what kinds of, are there different metrics that you're looking at these days, given COVID, has the temperature on risk changed? What's that sort of looked like?
So at the very beginning of the pandemic, there were a lot of funds that we would talk to that say, hey, we're going to keep taking meetings with entrepreneurs, but we're going to be pens down.
Yeah.
We're just kind of, we're adding it to the CRM. We're getting to know these people, but we're not going to make any investments because there's too much unknown during this period of time. And then there was another crop or cohort of investors that said, hey, this is a dramatic step function change in the value proposition for some companies. And for example, people that are targeting healthcare, telehealth is a clear winner in this category. Education technology, people that are targeting kind of hybrid learning environments for K to 12, or people that are focused on university experiential learning alternatives. Those are, in e-commerce, those are very clear winners of the COVID situation. So there were the more forward-thinking and risk-seeking investors that were looking at what industries are going through a step function change in the value proposition. They were making early and aggressive bets on that. But I wouldn't say that it's the risk-off trade feels like it's part and parcel of that tale of two kind of startups, which is the growth stage business and the pre-scale, the pre kind of true product market fit and repeatable sales and go-to-market strategy. And that segment of the market, I would say there's more risk off than I've seen in previous cycles. And it's a reflection, I think, of a few things. One is that at that stage, when you're investing, you're making a bet very much on the team, recognizing that there's likely a few micro pivots that are going to happen along the journey. And frankly, it's just very difficult to build super high trust relationships with individuals over Zoom and not having that in-person component of your diligence process. That being said, we've overcome it. We've deployed 40% of our fund 2 in the last 6 months. So we've, much to our LPs' frustration, we've been spending like absolute drunken sailors, as they would say. But we think we've been effectively deploying it towards what we think are some really incredible opportunities. And the approach we've taken is that there is, contrary to what I think is popular belief, there has never been a better time to start a early stage business. You have incumbents that are fixated on staying alive. They're fixated on figuring out ways to make their high fixed cost structure work for them. So they're in pure survival and optimization of their legacy infrastructure mode, which creates just an epic opportunity for a new entrant to come along and start to chip away at the market share or enterprise value that those incumbents have created. So we've gone all the way. What's changed in our process is that we've gone a lot earlier. So we funded our first single person team and a pitch deck business, which is very atypical for us. But we went all the way down to kind of inception level, and we co-founded a business that's still in stealth mode. But we went all the way down the stack of saying, hey, we have some unfair knowledge in some categories. I believe we have access to some really interesting and awesome talent in the ecosystem. So we aggregated that together, put it with what we believe kind of was a good V1 business plan, funded it, and they're away to the races. So we've done a few things differently since this whole thing kicked off. Yeah,
you guys have definitely been busy. So so just maybe on that thread of sort of the smaller companies who are starting out early stage, what advice then do you have for them who are launching either financing rounds, in this environment, or looking to pitch to funds like you guys or others in town?
So I think on the positive side, there's never been, I think you will get a much better audience and reception from funds because instead of people being on planes and in perpetual kind of meetings, I'm sure everyone's experiencing this. You just feel like you have more time to take more meetings. Things start on time, they end on time. There's no meeting creep that takes place. So I think you'll find a better reception amongst cold outreach, as well as trying to go through your network and define the warm introduction, which is such a nauseating term, but it's unfortunately, I think, the truth of how most deals happen. So just to unpack that a little bit, the warm introduction, which has kind of been the conventional wisdom for a long time, which is you try to find someone that already has a really high trust and good relationship with that investor to vouch for you and be your reference into that fund or into that investor. And it's true, it does help a lot. Like when Greg Smith, CEO founder of Thinkific, introduces me to a business, I naturally spend many more cycles learning about that company before I take that first meeting, and I treat it a little bit differently than I would an inbound cold introduction through LinkedIn or from a lower trust, less impactful relationship.
Yeah, I mean, that makes sense. You've got the great reputation of Greg behind, knowing that he's going to be recommending companies that he sees something in as well. So, and in terms of those early stage companies, financial metrics or other items, are there any particular metrics that you're looking at more carefully because of COVID, or has the process in that respect been very much the same?
Process has been largely the same. I would say that at the very early stage, if you go down to that foundry level pre-seed where you're writing kind of the first $250,000 or $500,000 check into a business, what I care about mostly is making sure that there's very strong founder market fit. So getting a very good appreciation of why this team or this individual is uniquely qualified to tackle the problem that they're going after. We then have, and we have a blog post about it, but I'm not going to rattle it off here. We kind of have like a founder checklist of the 6 things that we would look for. And that's like a scorecard internally of what we would look for and how we're grading the team that's put forward. And I would say the other thing that's changed, not on a metrics perspective, but what I've matured and come to appreciate more is that at the very early stage, the kinds of pivots that we're willing to, and I like to take the risk on, are pivots, not wholesale pivots in like a Groupon where they went from being, I think, a clean tech business to Groupon, which is like a hard pivot. I don't know how you accomplish that or how you would underwrite to that at the pre-seed stage, but I like the strong founder market fit, and you're pivoting the product or the solution around the market as opposed to wholesale changing the market that you're going after. And those are the kinds of investments at the early stage and the risks and the pivots that I'm willing to take.
The thought, there's been some thought behind that. We just have a question here in terms of link to a blog post. I don't know if that's something that we can
totally
get and share that with everybody. I assume it's on the Rhino Ventures website there.
Yeah, I'm just loading it in right now.
All right, maybe we can shift gears a little bit. We did talk a bit about, you mentioned it sort of off the top with, the latest investment with Thinkific and the amount given, the amount that was invested given the size of the fund. And so, leaning on co-investors to come into investment with you guys. Are you seeing funds that are sort of earlier in their life fund being more open to new investments in the current climate versus funds that are sort of more later in their cycle? Or has there really been any pattern or change there?
I've seen definitely the risk off trade at the early stage take place regardless of where someone's at in their fund life cycle. I think it's more, frankly, I think it's more almost partner dependent, so less firm specific as it is individual dependent. And there's what I think is encouraging about the Canadian venture landscape is that there's and this is not to be disparaging at all to the old guard, but there's a new guard of investors that are coming up that I believe are more entrepreneurial and willing to look at some creative solutions for companies, and um, willing to make and take risks that frankly can help them in their own kind of career pursuit. So not that we at Rhino think kind of in a career ladder kind of way, but if you put yourself in the shoes of a new and emerging kind of partner within a venture fund, they have to find their edge, and they have to find what they think is going to be the next and cool thing that is going to be fund maker for that firm. And so I think there's risk tolerance variance within an individual fund, and I would say the risk tolerance skews heavily towards the new individuals that are making investment decisions that have the clout to actually take something through investment committee. And I would say that's where I find the most interesting dialogue is taking place in terms of the moonshots and the high risk and the more entrepreneurial kind of finance bets that people are willing to make.
Yeah. And are you finding like the process in terms of engaging co-investors on investments has pretty much been the same in terms of the post-COVID world? I mean, everybody's looking for investment provided that they've got the funds left in their own fund. So is this, I mean, these are probably ongoing, as you've mentioned, ongoing relationships, relationships that the funds have with with their own investors as well as with other funds in town. Is that something that you're seeing any changes on?
What I would say is that we have never had so much American inbound interest. So yes, the cross Canada stuff is happening. Frankly, there's no early stage capital in Western Canada. I mean, there's a few. There's Connexus Credit Union out of Saskatchewan. Azure Capital out of Calgary does some early stage investing, but there is frankly just so few co-investors, institutional co-investors that sit in Western Canada. So there's some that's taking place across Canada, but the lion's share of where I'm getting the most kind of co-investor interest from is from American funds that are dying for differentiation in a world where there's 1,000 seed funds in the Bay Area, and these groups are looking desperately to find new and unique deal flow channels and ways to invest in companies where there isn't 5 term sheets on a pre-seed deal at a $40 million pre.
Yeah, makes sense. And just in terms of sort of American investment or U.S. investment in Canada, I know some of your, you've got a number of portfolio companies. Have you received sort of more interest on the American side since sort of COVID has taken place, or is it largely been driven, the trend been driven as it has been, for the past couple of years, that Americans are increasingly becoming more interested in Canadian companies?
Yeah, no, it's definitely an up and to the right kind of graph of the amount of interest from American funds. And I think that's core to the Rhino thesis, is that we want to be the first backer of companies and be there when I think it's that formative stages of some of the most difficult decisions are made. And we want to be that partner that entrepreneurs can lean on. And then for companies that do mature to that growth stage, to say that, hey, if you like the way that our relationship is progressing, we can do the things like what we did with Thinkific, where we can be the only capital provider to a business across the continuum. Mm-hmm. So it's usually a life cycle fund is $1 billion kind of entity that makes some tiny early stage bets to buy option value. We're kind of reverse engineering that by saying, hey, let's start super early. That is our bread and butter. That's where we want to be experts. That's where we want to spend all the time and effort with our entrepreneurs, and then earn the right to write the $15, $20, $30 million check into these businesses and continue to support them into the future. But at that point in time, those companies have incredible option value of who they go to, and the most aggressive funding partners that are trying to get access are definitely the Americans.
Yeah, makes sense. Maybe we can talk a bit about sort of deal terms and recent deals versus past deals. Given the change in the landscape, are you guys looking at either increased, maybe more aggressive deal terms, or changes to deal terms, or are you largely sitting the same position on, when you put a term sheet in front of a company, are they largely the same as they would have been sort of pre-COVID?
Largely the same. You know this, Laura, well. I dislike structure. I like to price in what I think is a fair and reasonable price and remove all that structure that obfuscates what I think is what a fair market value of the company should be. When you introduce structure like participating preferred shares, ratchets, and accruing dividends, it muddies the water of making sure there's perfect alignment of interest between your funding partner and the entrepreneur. And I just don't like anything that sits in between and muddies that water. So our sheets have become, I would say, the opposite. I think they become progressively cleaner. We become steadfast, I think, in some of the things that are must-haves, and then very flexible on other items. Mm-hmm. But I like very clean terms. Price it in, work with the entrepreneur, have the hard discussions up early in the relationship, and then make that. I think that sets the foundation of that relationship up for long-term success.
Yeah, absolutely. Like those deal terms are going to be living with the company and you for sort of the next iterations and future financings. So interesting. From the term sheet perspective on the legal side, just given changes in the COVID environment, there are we're starting to see participating prefs a little bit more often. But to be fair, most of the term sheets that are coming to clients are largely in sync with sort of industry standards. So, the CVCA and VCA model docs are very much, sort of continuing to rule the roost there, which is nice from a certainty perspective for companies as well, and making sure that those companies are sitting sort of in line with their, other companies in the same industries and whatnot from an investment perspective.
Am I allowed to ask you a question?
Totally.
Or is this a one-way?
No,
Q&A?
Really okay. The past 25 minutes. So yeah.
Okay, so I'd be interested in your take on what's happening to deal costs, so closing costs, both at kind of early stage as well as Series A, and what factors really influence the cost of completing a transaction. For most people, there's no bankers involved. This is just a pure kind of legal consideration.
Yeah, so largely, for the most part, we have, with our investor clients, we have sort of a general range that we try to stick to, and a lot of that is really going to depend on, where the company is at, because obviously the further along the company is, the more complex the transaction is likely to be. There's going to be more diligence, there's going to be more paperwork, there's going to probably be more investors that we need to, existing investors that we need to deal with. So from that perspective, we try and stick with the range, which we think is pretty market. I haven't seen a whole lot of change in terms of pre-COVID, post-COVID on those fee caps. I'd say as a general comment, investment as a whole is it's still active, but from our perspective, we've really ramped up on the M&A side. But yeah, from a cost perspective, I think really the complexity of the transaction, the more we can stick to sort of CVCA and VCA model docs and model terms, as well as diligence and making sure that the company has had proper legal counsel prior to our involvement is sort of the key factors when we look at setting costs for, at least from the legal side. Like as you said, these aren't, they're investment bankers or other. There might be a little bit of accounting or tax, but generally it's just the legal costs.
So you're probably going to give me crap for this afterwards, but if I was to say, okay, on like a percentage of the round size, what's a fair and reasonable cost structure versus tipping into the offensive territory?
Oh, I don't ever think about it in percentages. I can give it to you in terms of sort of like level of like the series rounds. So for like safe rounds tend to be the cheapest. Series A, I think we generally like to be within the ballpark of like 30, 35, 40, depending on where the company was at before, if they had legal counsel, how long they've been in existence. Convertible debentures are a little bit trickier, depending on if they're secured or not. We may need to pull in banking lawyers. But that's generally where we like to sit on Class A. As you get to Class B, C, obviously, that's going to increase, and part of the costs there are going to be based on instructions from clients. So if you tell us that you don't want to do any diligence, we'll say, Jay, you need to do some diligence. But if you decide not to, then that's at your own risk. And obviously the fees are going to reflect that.
Cool.
Yeah. All right. All right. So let's maybe talk a bit about just looking at my, this might be a good time to talk about the place. I mentioned convertible debentures. Might be good to sort of talk about in this COVID environment, sort of where does venture debt and government programs fit, and how should companies be thinking about those different instruments?
So I really like venture debt. I know there's some equity investors that don't, but venture debt, depending on the type we're talking about here, but it is easiest to put venture debt in place in connection with an equity financing, which is like conversely, that's the time when you need it the least, right? If you get a term loan at the time that you've just closed a $3 or $4 or $5 million seed or junior Series A, you don't need that cash, and it's expensive to sit on your balance sheet when you're paying whatever it is, prime plus 5% or something like that to a term loan provider. That's probably actually way too expensive. But like a prime plus 100 or 150 basis points from Silicon Valley Bank plus some warrants or something like that, it can be expensive. So what I really like is what some of the charter banks have been offering, which are the SaaS lines of credit. Different if you're a marketplace business or e-commerce, I don't think you have that same optionality, but what like Sid Paquette is doing at RBC and Joe Timlin at CIBC, there's some really good SaaS underwriting teams now that understand that business model very well and are willing to lend at 5+ times trailing 3 months MRR and at very inexpensive rates with no unused line fee. So it's not a term loan, it's a revolver. And that's a no-brainer to me to have that as a relief valve for many companies. And I usually will put that in place in connection with any of the equity financings that take place. With respect to government grants, so we never fund a business on the basis of assuming there's going to be government grants that reduce the cost structure. I would also caution entrepreneurs against chasing grants and building that as like a core muscle of your organization. It's not a core competency. Those, in my opinion, you outsource or automate the grant sourcing process. So like shred claims, use a shred consultant, go to Boast, don't build up that muscle internally. I think that's time wasted with a super high opportunity cost if you're engineers spending time and effort on that. And I think that grants in Canada and tax credits, we are disproportionately, we have a very favorable regime in place that you can get a whole bunch of leverage on every equity dollar. I would just really strongly caution against building that as a core competency of the business and changing product direction or changing engineering effort towards searching for those grants versus North Star should be finding product market fit, shortly followed by let's find the repeatable go-to-market strategy that we can scale this thing. That's my 2 cents on grants.
Yeah, and what about so you mentioned some sort of SaaS lending. What about things like Comerica, just general sort of credit facilities that you've yay, nay? I think sounds like they've got a place, particularly if you're doing a financing round, you're going to get probably the most favorable deal terms that you would get at that time if you're not needing to draw down on those. But your thoughts there?
Yeah, we view them very much as partners. I much prefer having the SaaS lines of credit in place at the time of the financing. And then if there's a need for a term loan to bridge to a next financing, and maybe it's in connection with some equity cash that comes in, and so the combination of debt plus equity forms that bridge, that is attractive. And we view those like the Silicon Valley banks and Comerica's as partners. But I view it as less relevant when you have a super already what would be classified as like a lazy balance sheet, which would be cash heavy, that you're waiting 18 months plus to deploy that capital to productive uses.
Yeah. We have a question here. I might just from Peter Conifal, who says Vancouver is home to some really interesting fintechs in a variety of areas. Can you comment on fintechs, professional services firms, or cloud accounting? Is there anything happening there that you're aware of? Anything interesting?
So cloud accounting, obviously there's bench accounting, which is trying to tackle the do it for me kind of model for SMB and very small business bookkeeping services. Super interesting business. If they can actually make that leap from the human assisted to a more automated solution, I think there's a pretty big pot of gold at the end of the rainbow for that business. We have an investment in a company that Osler acts for, Beanworks, which is accounts payable automation. And I think that whole AP, AR, and cash conversion cycle optimization world is going to get very interesting. And then we have a very sizable investment in a business called FiSpan, which is focused on making banking products consumable from within your ERP, which does house obviously most of your cloud accounting or on-prem accounting solutions if we're using a legacy piece from Oracle or NetSuite. And those are the businesses locally that selfishly, obviously, and from a self-interested perspective, full disclosure, FiSpan and Beanworks are portfolio companies. Bench Accounting is not a portfolio company, but those are the ones that I think are super interesting and onto a good path.
Awesome. Hopefully that answers your question, Peter. I want to talk a bit about, so we've talked a bit about sort of like the COVID impact, how things are changing, how things have changed or not changed. I want to talk about the COVID impact on, companies that are sort of seeing things going south because of the impact, whether they're in an industry that's, not able to gain traction right now or funding is difficult to access. What kinds of advice do you have for those companies who are, sort of struggling to stay alive during this time?
So they're difficult discussions, but that's kind of the reason why we wanted to title this talk the raising capital or getting to break even. Because the getting to break even, if that is an option for you, if you do have revenue and you do have customers, that is the path that we push our companies towards. If we don't think that they're on either something has fundamentally changed in the market, or they are at a point in time that is not mature enough to raise the next round of capital, we advocate for getting to that break-even state. It's incredibly painful. We usually have something that we call like the red folder strategy, which is your series of layoffs that have to take place to get yourself, and cost reduction efforts that have to take place to get to break even. And the one thing that I've learned throughout this process is that you never cut deep enough on that first round of layoffs. And so that's where we try to bring some of the experience of having been through it a number of times now, of making sure that we're cutting deep enough on that first round of layoffs, because there's nothing that crushes morale like you doing one round of layoffs, second round of layoffs, third round of layoffs. In our opinion, it's much better to do it deep and hard on the first round, then start to focus on rebuilding that morale and that culture by instilling a layer of confidence that there's nothing subsequent that's coming down the road that's imminent, at least.
Yeah. I mean, difficult decisions to make, but, take your point that better to do it now and get it sort of over with and start, from scratch if you need to, and build out from there, rather than sort of continually putting your employee base workers through sort of constant concern that their jobs are on the line.
Exactly.
Yeah. Let's kind of talk a bit about the future. So where do you see Rhino's focus on new investments over the next year? Do you think, once the COVID environment has passed, what is that going to look like? Or maybe it'll look the same. Sounds like a lot of your deal terms and things like that are remaining constant. So maybe that's not going to be a big impact.
So the future of Rhino, I touched on it in a couple of questions, where I believe there's an opportunity to reverse build the lifecycle fund. So I believe that if you enter at the early stage and you earn the right and you be the best partner you possibly can be to that company, like a Thinkific, you earn the right to write that $22 million check at the growth stage. So that's more of the future that Rhino is going to have in store for Fund 3 and beyond. From a thesis perspective, I believe that the crown for Western Canada, being the fund of choice for entrepreneurs that are building venture scale businesses, is a pursuit that we are trying to tackle, that we're trying to expand beyond Vancouver and go all the way up to Ontario. I'm a Toronto native, but I'm cutting it off at the Ontario border. So we want to own Western Canada and be the very best partner to entrepreneurs in those jurisdictions. So that means we're going to be scaling the team. It means we're going to be raising another fund. It means we're going to be actively deploying still at the early stage. It means we're going to do the same thing that we always have done, which is build hyper concentrated portfolios from the very beginning. That means kind of 10 to max 15 companies per fund, which for context, that's about half of the normal amount that a typical venture fund would have. And then hyper concentrated near the tail end of our fund life cycle, where we're going to put as many chips as we possibly can into the companies that we think are scaling really nicely. That doesn't mean by no way does that mean that we are abandoning any of our companies. My co-founder of Rhino, Dan, always had this policy of no person left behind. So we always spend time and effort with every founder that we're on the board of and that wants that engagement from us.
And just on that point, has there been a greater focus on portfolio companies in the COVID era, or you guys are largely involved to a significant extent with your portfolio companies? It's not just a matter of investing and sort of sitting on the sidelines. So have there been sort of substantial changes there in terms of process, or are you guys sort of keeping constant?
I would say we spent in March and maybe in April, we spent a lot more time working with our companies through some of those very difficult decisions that had to take place of raising or getting to break even. I would say that things like the Thinkific raise, that took a ginormous amount of time and effort. And we've done a few of those with some other companies that are not announced. So those are huge time sucks and time commitments to the betterment of the existing portfolio. That being said, we co-founded a business, funded a business with a pitch deck and a person, and made our first investment outside of British Columbia, where we had never met face-to-face with the founder. So we have been, I'd say, our LPs might accuse us of a lack of focus, but we have been all over the place in terms of starting companies to funding businesses to working with our portfolio businesses.
Yeah, well, I mean, you've got all those balls in the air, and looking to expand throughout all of Western Canada. So you've got to if you're going to commit to that, you've got to really commit to it. So I applaud you guys for doing that.
Thanks.
I wonder, I think we've got about 15 or so minutes left. I'm wondering if it might make sense if there are questions. Haven't seen anything else pop up in the chat. Let me just check here. Nothing else in the chat. Maybe I'll give people a couple minutes to sort of gather the thoughts, and feel free to include some questions for Jay or for myself if you'd like. Looks like we've got another question actually in respect of target MRR and year-over-year growth. Sort of what would an ideal target company look like? Jay, can you maybe speak to that in terms of Rhino's views?
Yeah, I'm not trying to dance around this question, but I'm going to. And there's a reason for it, and that's there are some businesses that are showing really great MRR traction, very strong year-over-year growth, but might not check the box of being this is a venture scale opportunity or a venture scale market, or there isn't long-term forms of defensibility that can be built into the business over time that make it unattractive for us to invest in. And there's other companies that you recognize that revenue is a lagging indicator of success for a business, and there are other things that you would equate enterprise value creation to in the interim. So whether that's a number of integrations, if that's building the initial liquidity for a marketplace, there's a number of things that we look at as proxies for enterprise value before revenue might actually start to uptick. And I think that's the role of any seed investor, is to really understand your business, the market dynamics, and what it's going to take to build long-term durable value. Sometimes I think companies focus too much on revenue at the early stage at the expense of the long-term category creator or the category defining business, because they try to over monetize their first enterprise customer versus using them as a reference customer and then being able to sign up the next 4 or 5 big companies that are in the same target market. And so I'm trying not to dance, but that is my dance around that question. If you really had to pin me down and say, what's a straight down the fairway SaaS business that's venture scale with a good market and good long-term defensibility, I would say it's between 25 and 100K of monthly recurring revenue, and you are showing a happy path to more than doubling year over year. So you may not have the sales and marketing spend to actually bring that to fruition, but I want to know that there's early indications that the channels and the unit economics that you are putting forward suggest to me that there's depth to them and that I can put capital towards that with a super high return on invested capital.
Yeah. Okay. Yeah, Thomas says double the fund. All right. Other questions?
What's the mandate that we sell to investors? I wonder if the root of that question is because it seems like there's a lack of focus for the fund. But so the mandate is pretty simple. It's that kind of what I led this session off with, which is we think there's a dearth of the quality and quantity of early stage capital accessible to entrepreneurs in Western Canada, and that's the problem that we're setting out to fix. We think it's no surprise, I think, to anyone that would be in this conversation right now that there are massively successful and a ton of enterprise value from technology businesses being built in Western Canada that are outside of that center of the universe sphere of Toronto and Montreal or the Bay Area. And I think shining a spotlight on that and enabling the next generation of the iconic Canadian tech companies that come out of Western Canada is part of the pitch that we spin to LPs. Oh, so you're asking, oh, I got you. You're asking for return profile metrics. Gotcha. So early stage fund math is different than growth stage fund math. Growth stage fund math is very simple and standard line that you'll get from a SageView or a Silversmith or someone like that is going to be, we underwrite to a 3 to 5x in 3 to 5 years is the time frame and the return profile. And most of them will say, and we've never had principal impairment in the life of our fund. So what that means is they're trying to say, hey, we've actually never lost money. And usually that's a result of structure, not because the company was unsuccessful. In reality, what I see more frequently is that growth stage funds might say that as their criteria of success, but what they're willing to assume is closer to a 2x in 5 years. Just because of that glut of capital at the growth stage that I talked about. That's not the world that we operate in. That's the more mature part of venture ecosystem and growth stage ecosystem. The math that we have to play is the simplest way to comprehend it is a return the fund kind of level of thinking, where with each investment, I have to believe probability that there's a possibility that that investment is going to return the fund. So there's a follow-on question of how large the fund is. We touched on this at the beginning, but Fund 1 is $15 million and Fund 2 is $33 million. And we'll have some stuff about Fund 3 in the future, but that's the rough math that we're going through the back of our envelope, as well as more than back of the envelope. That's what we're doing our math towards is, does this have the potential to return the fund?
All right. Some more questions about EdTech this time. Trends seen in EdTech in the past month, metrics focus specifically on. I know you guys have some EdTech companies in your portfolio, so.
So I'm a big fan of EdTech. It's been depending on the audience, I tell people that we're EdTech and FinTech curious, which is true if you look at our portfolio. Although we are a horizontal fund, we've done lots of different investments in different categories. But EdTech has been a long time long time edtech has been out of favor with investors. And the reasons being are it's a glacial sales cycle. Budgets are impossible to unlock, specifically at the K to 12 segment. And the buyer universe just royally sucks. Even if you can get around 1 and 2, the multiples paid for edtech businesses at maturity just blow. But I think we are in a point in time where that entire narrative is being turned upside down, where there is an urgency to digitize the classroom from K to 12. There's an urgency to offer hybrid education tools, so tools that are going to be both accessible and usable in classroom as well as from a remote kind of setting. There's the need for synchronous and asynchronous education. That's Zoom and Microsoft Teams are not the be-all end-all. These are horizontal solutions that have terrible vertical applications for the classroom. So we've made an investment in a business called Shobi, which is a digital classroom product that's a communication hub that offers essentially what I just laid out, which is synchronous and asynchronous education, Slack-like interface in the chat ability, grading, contextualized grading feedback, where you with a stencil can mark things up and add a voice note and pass that on to the student, so the student actually has more than just a, yeah, you got a 6 out of 10 on this quiz. And it brings in the best-in-class point solutions, which is also one of the big qualms of the ed tech sector, is that there is a million gravestones or zombie companies that are ed tech point solutions that have strong user bases but have failed to monetize, failed to find a way to monetize. And I think that's going back to the first kind of 3 issues that most investors have with ed tech. That's going to change, I think, when some companies finally build platforms that have found a way into the not only the teacher and the principal level, but the district level so it's an enterprise-like sales. And once you have that kind of aircraft carrier, the one platform that you can then bring in the very best-in-class point solutions, I think it's going to open up a world of monetization opportunities for those point solutions.
Yeah. Just looking at the additional comments here. All right. I've got a couple more minutes if there are a few more questions or anything, Jay, that you kind of wanted to touch on that we missed. I think we had a few sort of key speaking points that we wanted to get to, and I think we hit most of them. There's another follow-up question in respect of ed tech. Do you see opportunities for certification of experiential learning, validating know-how, or traditional delivery mechanisms? Are they the main focus?
Yeah, really good question. And that's frankly central to our investment thesis in Thinkific. So for people that don't know what Thinkific is, I hate this analogy, but they're the Shopify for online courses. So they are the enablement layer for knowledge commerce and membership sites. So what I think is super interesting, what that allows you to do is you decentralize education. You move it away from these institutions that, and I was an adjunct prof at UBC for 4 years, and I can wholeheartedly say that, hope there's no one from UBC on this, but I think the model of higher education has moved way too far away from student outcomes being the North Star. And you see the US has a way bigger problem with this, where the inflation of tuition is going up like this, and I think the value delivered to students is on an opposite trajectory, making this chasm of the price to value even more, the most acute that I've seen, I think, that anyone's experienced in the history of higher education. So bringing it back to Thinkific, what I'm extremely excited about and bullish on is decentralizing education, putting it into the hands of what are the best niche and vertical specific educators in the world out there for them to then go and monetize and offer that value to students and end users in a disruptively priced way. And I think that certifications go hand in hand with that. I think that the very best businesses built on top of Thinkific, like Corporate Finance Institute, actually another Vancouver success story, they have a very strong brand and certification process that goes alongside their educational offering. And I think that's the future. I think there's one more missing piece that I'll add on there, which is that certification is one part. I think the community element is the last piece that needs to be added to this value chain or tech stack, if you will, where I think if you reflect back on your time in undergrad or a master's or whatever form of education you had, that social and community-based component of your education was so critical to the value extraction you got from it. I think it's maybe not something you realize when you make that initial decision of where you're going to go or the value you think you're going to extract, but it's something you realize once you're in the program, and it's definitely the lion's share of the value that you extract post-program. So I think that same experience has to be replicated in some way in a community element for the very best knowledge, commerce, and online courses that are looking to unbundle and decentralized traditional education institutions.
Yeah, definitely something that I think is a struggle currently with the virtual and home learning and whatnot is really that missing camaraderie with fellow students, colleagues, what have you. So I think there's a lot of struggle on that, not only in education, but I think in a lot of workspaces in particular are struggling with that. Yeah.
Totally.
All right. Got a couple more minutes, but I'm not seeing any other questions here. Some good chat going on though. Well, maybe if there's nothing else, Jay, unless you have any sort of closing remarks, I think this has been an excellent dialogue, and thank you so much for taking the time to share your insights and your experiences and Rhino's history and future with us. I think it's been super useful for everybody who's been watching, and I thank everyone for participating.
Of course. I'll do one last thing, which is a shameless plug for Osler's. So biased, they do all of our work, but in my opinion, Laura, Justin, Mark, and the entire team over there are absolutely first rate. So if you are at that kind of formative stages and looking for first rate counsel, biased, but that's 100% where I'd be going.
Thank you, Jay.